So we worked with someone who was a foreign national. They didn't have US credit, right? So they lived in the UK and it was for a sizable short term rental property. So they had a lot of things that working against them. They didn't have a FICO score because they didn't have any kind of income or history in the United States. They're a foreign national. They had been turned away from so many people. They had money, but a lot of it was tied up into their IRA account and their pensions.
Hey everyone, Keshav Kolur here. Thanks for joining us today on our episode of Investing for Generational Wealth. I'm Keshav Kolur, founder and principal of Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation, passive income, tax benefits, and more. And more recently, we are also expanding into more wealth advisory services, so retirement planning, tax strategies, life insurance, etc. And together with investors so far, we've helped allocate coming up on $13 million into more than 1,200 apartments nationwide, 100 single-family rental homes under development, 56 oil and gas wells, 14 industrial warehouses, and private lending. And just before we begin, just a quick disclaimer, we are not financial advisors, legal advisors, CPAs, any professional advisor as such. All investments, financial strategies are subject to risks, including the possible loss of money. So always perform your due diligence before making any financial decisions. Consult the professionals in your life. And with that, I'm your host, Keshav Kolor, and welcome to today's episode, Creative Lending Strategies That Traditional Banks Cannot Offer.
Yeah.
So today's guest is Aaron Marsh. And Aaron, thank you for joining us today.
Yeah. Thank you for having me. I'm looking forward to this.
Yeah, it's going to be a great episode. So just a quick background on Aaron. Grew up in Dallas, Texas. He's now president of Marsh Lending, a private lender, almost an alternative lender. And just from the reviews online, people are ecstatic about working with you and very excited. And so thank you for being here with us today, Aaron. I gave like a 30-second spiel, but could you dive into your background a little bit more?
Sure. Yeah. You really touched on it. What we pride ourselves on is our client relationship. So everything we do is in partnership on all sides, right? It's just not transactional based. And so the kind of reward for that is we have had a lot of great Google reviews. We've had a lot of great clients that refer us and recommend us. We have a lot of great working partners on the banking side, on the family office and private lending side. Everybody is really big at the referral for us. Where we are now is we're really defining ourselves in terms of we're a traditional lender. So we'll do primary home, investment home, commercial properties. We do some business to business stuff, just depending on what it is. We're fully licensed in Alabama, Texas, and Florida. We're based in Florida. And then we do commercial and investment property loans in about 38 states. So that's like a broad brush of what we do. And just as this episode is, and why people clue in to your podcast is we kind of can think outside the box and we listen more than we talk, right? So we listen more to about what is your client's needs, what can we do, what have we done in the past. It's highly creative, and those are the things that we try and bring to the table for you to look at as options and review your best course.
Gotcha. Okay. And if you could just give us a quick spiel about how you got to where you are today.
Yeah, not everybody just wakes up and goes, I want to start a mortgage company, right? And so I have a long background in corporate America. So specifically finance and operations in some pretty large companies. And we did I did 18 plus years at J.C. Penney in their finance and operations, headquartered in Dallas, the Plano area. We're Dallas transplants. We're now based in Florida, where we are now. And how we kind of got into this was during COVID. I had a lot of friends and family who were looking to refinance during that big rate drop down into the twos that a lot of people are still hanging on to. And so I was at home and I had a family friend who owned a boutique mortgage company. And he said, "Why don't you just help me out with this? And just, you're at home anyway, just get your license." So I got my license, kind of got my feet wet into understanding about it. And we kind of just grew from there. We weren't specifically reaching out and getting new business. We were just kind of helping friends and family refinance out of their 6, 7, 8 mortgages down into the twos and threes. And so once we got past that, we saw where there was a need in where we like to vacation, which is a high resort area. And so I transitioned from the corporate world into starting my own firm in Florida. And we specialize in those investor properties, short term rentals, condos, duplexes, commercial properties, lots of multifamily, that kind of mixed use. That's how we kind of transitioned. So I didn't wake up the day after college and start in the mortgage business. I had a long career, but I'm taking a lot of those learnings here and launching it.
Gotcha. Okay. Very exciting. And then
Yeah.
just looking on your website here, you mentioned that you have a lot of alternative strategies where you typically work with folks that traditional banks might turn away.
Yeah. Yeah, we
And
do.
so, yeah, if you could speak more to that.
Yeah. Yeah, sure. So I always, just to frame it up, and so your audience and you have a better understanding of where we can come from. I use one of our clients, he has 17 LLCs. And so for him to go into a bank, even at a bank that he does a lot of business with, and to bring all that paperwork in and dump it on him, that's just an underwriting nightmare. And a lot of underwriting nightmares turn into no's instead of yeses, right? So what we do is we really look at a lot of, I'm sure your audience is familiar with like DSCR and those kind of terms where they use the rentals from the property and the market value of the property to qualify the loan, not necessarily their personal income structure or their taxes. And so we do a lot of DSCRs, we do a lot of bank statement loans. So if you own your own company or if you're like a 1099 employee or a gig worker, not necessarily that traditional W 2 worker, the banks love those W 2 workers. They really have a hard time with the self employed because everybody has a tax strategist, right? So their tax strategy is to show that at the end of the year, I have like 2 candy bars and a 6 pack of beer, and that's all I made for this whole year, right? They want to lower their tax liability as much as possible. And we understand that. So, what we look at is different forms of kind of qualifying this. So, do you have like a large asset account, like maybe an IRA, 401k, or a pension plan, or maybe you have a lot of money in the market, but you don't want to close out of a position where even if you were investing in the S&P, you're making 15, 20% over the past few years. You don't want to cash out of that to put it into a mortgage, right? And or to put it into a property 100%. So we'll look at that and we can qualify you based off that account. Not saying that you have to liquidate that account, but then we don't need to see like your tax returns or a lot of the verification that way. We've had a lot of interesting things come across our plate in terms of even using life insurance policies as a possible qualifier, right? So a lot of those things banks and credit unions don't touch because they have their guidelines that they need to check off all the boxes at the very start so they can resell your loan, right? So they're all into, I want to qualify you as much as I can up front to get you to a yes so I can resell your loan. And that's why there are a lot of times there are maximum limits on certain types of products and on the dollar amount and or what they will say yes to. Is it a clean, perfect file that ticks all the boxes? Of course they'll say yes. But not every investor's like that, right? A lot of investors, whether they're entrepreneurial, they're putting all their money back into their business, they're investing in many different things. And so we're here to help out in those situations.
Gotcha. Okay. And those regulations or underwriting guidelines that traditional lenders and banks follow, is that more government mandated, like hard regulations, or is it just banking regulations from a previous era and they just haven't updated it yet?
both, right? So if they want that mortgage to be backed or warranted by the government regulations, they got to make sure that they hit, okay, this is their verifiable income. We have 2 years of tax returns. Their DTIs are under a certain threshold, like 40% or 43%. Or if it's an investment property, we won't do it in an LLC. Well, 90% of our business, those are done in LLCs because that's how people want to set up their investment properties, right? And there's a lot of other things that go along with that, right? Is the property profitable? Is it in a flood zone? Is it so? There's a lots of reasons for them to say no. And I teach our team, and one of the things that we always come is, what's the pathway to yes? Yes, I hear what you're saying, but what's the pathway to yes? And once we can identify a pathway, then how do we negotiate and navigate around to get to that point? And so we look at all different kinds of options. We look at different types of lenders. Maybe this might be a situation where you're at right now and how quickly you want to get this done. It may be we have to put you into a hard money loan, but then once the property stabilizes or the rents stabilize or the rent roll, let's say you buy like a 20 unit multifamily complex, but it's only half rented right now, right? So get in there 12 months, clean it up, do your marketing, get the rents up to 80, 90%, and then we can just refinance you into a much better rate and term situation. But you've gained all that organic appreciation in the market because we helped you get it at the start if we had to go via hard money or something like that, right? And then we also look at alternative types of qualifications in terms of we're trying to make sure that we're matching rate, term, down payment, qualifying method that best fits your needs and what you're trying to do. Maybe you only want to hold it for 3 years. Then a 3 year arm is going to give you really good rates. And let's get you into that. And then you're going to sell it in 3 years anyway, or you're going to you know, refinance it and then put it on the market. That's better than possibly getting you into locked into a rate that's a 30-year mortgage or a 25-year mortgage on a commercial property or something.
Got it. Okay. Do you see traditional underwriting catching up at all anytime in the future? Would that really depend on
I
regulations
think
and things
I
like that?
think it will, but it hasn't got to the point where they're coming up with creative stuff, right? And so I keep trying to move our firm and what our ideal client profile is into like maybe a top quadrant, right? A top right quadrant. If you kind of think of the old BCG metric matrix or something, where you have the way we define it is if you have loan complexity on one axis and you have dollar amount or loan amount on the other axis. In the left lower hand, so it's low complexity, low dollar amount. So that would be like something like a starter home in a or a small condo, and it's a two W-2 workers, like a married couple, and they're getting in there. Banks and credit unions love that because they have what you just talked about. Those kind of underwriting guidelines fit that kind of niche. Then when you get into higher complexity but low dollar amount, that's when you kind of get into those. They have bad credit history, they need credit assistance, they need down payment assistance, they need maybe they're trying to get into like a specially regulated area or they need farm loans or something like that. So that's a different bucket of where people are. Then if you get further out, low complexity, high dollar amount, that's where you might get into something like, let's say someone is going to buy something for $1 million, right? A duplex, but they're going to put 500 or $750,000 down, right? So their loan amount isn't that much. They're highly liquid. They they have a great history. They're able to put down their tax returns. There's no kind of extra, complexities to their financial package. That's in that area. Where we really are starting to specialize is in the high dollar amount. So that's where banks and loans start to tap out, right? And traditional lenders, even like mortgage brokers, when you try and get above like a $3.5 million non-owner occupied rental property or commercial property, they tap out. But it's also high complexity. So on our axis, we're over here in the top right hand corner because they are just like our client that has the 17 LLCs, right? So They don't have a traditional, it's not easy for them to come in. They file multiple tax returns, they have multiple K1s, they have multiple ownerships, they have lots of write offs, lots of things. So tax returns isn't the answer. That's not going to help get you there. W 2 is not the answer. They have a lot of money in their accounts, but it's all working for them. They don't take a salary. You see what I'm saying? So we really have curated a lot of lenders and options and stuff to help those people attain the objectives that they want.
Okay. What would you say your maybe top 2 to 3 ideal clients are? Who are they? What's a dollar figure amount of the loans that they're going after usually?
Yeah, we that's a great that's a so we have two different sets. We have investors that buy commercial property, and whether that's, let's say it's a small strip center that has a washateria, a tax office, dry cleaners, and a pizza parlor in it, right? And those tenants are all on long-term leases, and they're good tenants and they always pay on time. We have clients that love to eat those up, right? So they buy those, fix up the property, the parking lot, and everything. They're high net worth. They have money that's tied up in markets and other properties. So they look great on their personal financial statement, but they don't have a ton of cash to just buy it outright. So then let's say that's a three and a half, four and a half, five and a half, $10 million property. Then we can help them come in at a lower down payment, leverage the rents that they have, and achieve what they're trying to do, which is acquire that property. Conversely, where we live is in a high short-term rental area. So a lot of the homes here are on Airbnb, VRBO. It's close to the beach or it's on the beach, and there's a lot of them have property management companies. So they want to buy it, put it in an LLC, put it on the rental market. Case in point, we have one client who has a house that's on the beach, and last year, just in gross rentals, it made $1.1 million. They definitely have. Now, the value of the house is much higher than that. It's 13, $15 million, but they charge and they get that rental income. But again, they may have multiple properties. They may have multiple mortgages, and traditional banks and stuff, really, they don't want to see you levered into three, four, five properties. That's okay for us because that shows that you have experience. If they're all getting covered by the rentals that they have, you're not behind on anything, you have good FICO score, and then the property qualifies itself. Those are the ones that we really like to bring on because we have five, six, seven different loan options or lending options at our fingertips to immediately jump into.
Okay. And beyond the access, the ability to underwrite these loans and service clients, then you're also saying on the real estate investors who are much more commercial and the short-term rental investors that you're able to get them better terms on the loans as well. Is that
Yeah.
correct? Okay.
Yeah. And then we also like to bring on first time investors because we've done so many and we have so many good clients that have done this in the past. Someone that's trying for the first time, let's say they like what we did. That's how we got down here is we would vacation here all the time and we would rent a house. And then we decided we want to get one. Right. So we're a first time investor. It's our first time to get into it with the insurance and the property management company and the landscaper and all the things. Right. How do we market it? How do we get the revenue? What, all of the things. And so we like working with those clients as well too because we can be a good resource for them because we have good partnerships in all the different pieces of the vertical that they need to try and make it turnkey, right? They want to buy a place, they want to make it turnkey. It's their first time of doing it, and there's banks and credit unions a lot of times don't lend to first time short-term rental people for whatever reason. They have their own requirements and underwriting, but that's where we can step in. We can help guide you through the client journey to help you get to the right resources, whether it's us from a lending standpoint or property management, property insurance. We have a lot of resources that we've partnered with that kind of help you with that and just kind of basically hand you a playbook so you can feel more comfortable and confident in the purchase that you made.
Okay. Operationally, when you're looking at building a relationship with a client, helping them through the process, growing that relationship, what would you say sets your lending firm apart from other lending firms, other banks?
We have a lot of experience on our team, and we have a good group of people who care. So you're going to get that constant contact. There's now, because of the where we are in terms of AI, early on, 12 months ago, 18 months ago, AI was just starting. People were scared of it. They didn't know what to ask it, right? Now, people use it every single day. It's almost built into almost everything that a lot of people do. And one of the things is, so there's a relationship between ourselves, the client, and then the client's chat, right? Or Gemini or Claude or whatever they use, right? And so as they're asking chat, hey, is this a good deal? Can I get a better deal? Chat's always going to say yes. But if you're not prompting it correctly on what you're asking it and what you're looking for, then it can't really decipher and give you back good ideas. Or a lot of times it brings back more information than what you asked for. And so then now you got to, as a client, surf through, what did chat just tell me on all of this stuff? That's where our team really steps in on a person to person, and with their experience base that our team has, really can answer a lot of the questions for them. And if we don't know the answer, hey, we don't know everything, right? and I'm not a personal chat, right? But if I don't know the answer, or if there's something that you say that's intriguing or interesting that we have to go get maybe an exception for, then we'll go dig for that, right? We'll dial for dollars. We'll go find that information that that may be unique or specific to your either your financial complexities or the property you're trying to do or what you're trying to do with it. So I would say our experience base, the way we handle things operationally, and our turnaround times really help, because almost every transaction we do now, it's really a three-party transaction in terms of it's our team, it's the client, and the client's AI, because they're constantly, whatever we send back to them, they take our entire email, throw it in a chat, and then it's back and forth. That's just nature of how you do business now.
Yeah. How have you incorporated AI into the lending business?
So we partnered with a couple of different people, and it's really unique, and not unique, it is a good time to be incorporating AI into your business. So we're working with some people who have turned on some Sky Lead campaigns for us through LinkedIn, where we're really reaching out. We have two different campaigns working. One is really working with investors that are out there searching for lending opportunities, right? They're looking for money to fund the deals that they want to try and invest in. And the other thing is, we're working on the capital side. There are investors out there that want to lend the money, right? And so we're really working with Sales Navigator. We've tied it into our CRM. We've tied it into our quoting process and our deal desk. So all of that kind of funnels in. The other thing that we're using AI for is we're using it on the backside to look at a lot of things that people have refinanced. Maybe they did an ARM 5 years ago in 2021, or 7 years ago in 2019, when rates were really starting to change at that time. And now they're coming up against a balloon payment, or they need to refi. And so we're using it to kind of do a warm reach. It's not necessarily cold, because I'm not asking you, hey, do you want to refinance your loan? We know that you have something coming up. So we're using some AI that's working on the backside in certain zip codes, that's really answering our question of, hey, who may need our service but doesn't know about us yet? And then we put them in the campaign.
Interesting. Okay. You've spoken about obviously the things that set you apart from a traditional bank and how you work with some folks who traditional banks wouldn't work with. Could you give
Right.
us an anonymized case study or a story, an example where an investor actually came to you, or a client in general? The bigger the better, or the more interesting of a story.
Yeah.
And traditional bank turned them away. Why were they turned away? How did you work with them? How did you come up with the solution? What were the parameters that a traditional bank couldn't have come up with?
Yeah. So I can give you a good one. We have a few to choose from, but one of them, it's not a high dollar amount, but it's like a warming story to us, right? And so what it is, there's a young kid, and everybody talks about affordability, housing affordability, how the first home purchase age has crept up over time. I think the Fed is really running some studies on that. It's really incrementally growing first home buy. And so what we did was we worked with a client came to us, and we worked with this client, and it was a young kid, and he wanted to buy his first home, and he'd been turned down from about, I don't know, 5, 7, 10 banks, something like that, because he was a server and a gig worker. And so based on, he didn't have a long track record because he had worked at a couple of different restaurants. Now he made good wages in terms of tips, but you couldn't really use tax returns. You couldn't use a 2-year work history because he worked at one restaurant, then he worked at another restaurant. He had a great FICO score, but there was also some other things that were involved in terms of, he was a first time home buyer. They couldn't qualify him because of what his work was. And what we did is we came in, we really worked with him. We got all of his documents in a nice package, and we did some unique underwriting with one of our banks that was willing to work with us. It was a wholesale lender, and they had a special program that was for this server world, first time home buyer, gig worker. And we got him into his first home, and he could not be more happy. He did a video for us, he did all kinds of things just because he was able to get into his first home where he had been told so many times no, right? And so we got him into home ownership, and now he's ready to move on to the next step. So now that he has home ownership, then he could sell that house and grow as his family grows or what else his needs might be. But the fact that we got him into his first home was great. Another one is, so we worked with someone who was a foreign national. They didn't have US credit, right? So they lived in the UK, and it was for a sizable short term rental property. So they had a lot of things that working against them. They didn't have a FICO score because they didn't have any kind of income or history in the United States. They're a foreign national. They had been turned away from so many people. They had money, but a lot of it was tied up into their IRA account and their pensions. And they wanted to use a lot of the rental income that this property was going to throw off from the short term rental standpoint to offset the expense of owning, right? So the payment, the insurance, the taxes, all the things that you need for the to qualify the loan or underwrite the loan. We worked with a private bank in South Florida that really works well with foreign nationals. And they hadn't heard of this bank. They had never gone to this bank. It was just a resource that we knew that we had in our back pocket. And so they were able to qualify for a $3 million loan property with no income in the US, no FICO, right? So we just have to assume a FICO, and then they just assess the interest rate based on if you had a FICO. So now they have the property, they're making money in the United States, it's paying for itself, and then they visit it about once every 4 to 6 months for a weekend or two and get to enjoy the beach. But they were another situation where they came to us as a last resort when they should have came to us at first. It's kind of like, how do we get our information out there? But foreign national, no experience in the US, no way to verify their income or any of that sort of thing. And then also it being a multi-million dollar property, you could see where a lot of that was a no, but we turned it into a yes.
Very cool. Especially the first one, a heartwarming instance
Yeah,
for sure.
yeah. And then we try and eat at that kid's restaurant where he serves for about at least once a quarter and request his table just to kind of catch up with him. It's really cool.
Nice.
Yeah.
Okay. For some of our listeners, I guess I myself, for example, this one statement caught me in terms of a business owner. I'm one myself, and business owners have a lot of tools at their disposal to reduce their taxable income, as you said, a lot of different strategies. And also at the end of the day, just continuing to invest back into the business. And so it's harder for them to qualify where a traditional W-2 might be a lot easier. And so how in those scenarios, selfishly, I'm curious, what would banks look at when qualifying them for different loans instead of income because reported taxable income is really low.
Yeah. So what we would look at if you came to us and let's say you wanted to buy a property, what we would look at is one is kind of how long have you been in business? What's your kind of track record there? But then also we would look at putting you into a bank statement type of loan. So let's say your business, everything goes into that one bank statement. It could be personal or professional bank statement. And we can look at it either 12 months or 24 months. 24 months gets you a little bit better interest rate because there's a little bit more skin in the game, a little bit more history there to see. But we can do it as little as 12 months, use a bank statement loan for you. Or let's say that you have a reserve account for your business that you keep a lot of cash in, or maybe you have a Fidelity account, Charles Schwab or something where you're investing in the market, right? You don't want to pull that money out of the market. But what we can do is we can look at that and say, okay, given that they have that, a lot of the lender, or not a lot, but quite a few of the lenders that we have, we can look at it and say, okay, if you take the payment and you multiply it by 60, whatever that dollar amount is, let's say that equals let's say the payment is $1,000 a month, 60,000 bucks, right? So 5 years worth of payments. Is there enough of that in their Charles Schwab account that we can qualify? And if you get 100,000 in there, 60,000's covered, right? So then we can use that to qualify you. Then when you get into it, then you may be renting the property out and you use the tenant's rents as your income to pay for the mortgage. However you want to pay for the mortgage. You can pay through your business, pay through your personal account. It doesn't matter. But to qualify you, like you said, we can't use traditional W-2s because you don't have any. We can't use traditional tax returns because you're using your tax strategy to your advantage. So we can use something like a bank statement loan, like a DSCR loan, like an asset loan where we're looking at like an account. We're not asking you to liquidate that account. We're just looking to make sure you have coverage there.
Okay. Okay, that makes sense. I'm trying to think what else.
And then, depending on what it is, we even have worked with some firms that do things like life insurance policies. So they'll put a life insurance policy on you and then turn around and loan a portion back to you. You never have to write a check or make payment on it. But obviously, at the end of life, then the payment comes out of the policy before it gets distributed out to your heirs. So we have seen some creative stuff out there for sure.
Do those methods require those same assets that are being used to qualify? Are those assets also used as collateral? Are there any restrictions for in that example that you had where you required, let's say, $60,000 in cash for 60 months of payments and the 100,000 sitting there, but then next month, if it isn't, is that a deal breaker or how does the bank look at that?
No, that just qualifies the loan, right? And then the collateral will be the property that you buy that the loan is against. So if you don't make your payments, then obviously you would forfeit the property. Now, obviously they would want to make sure that you could make the payments, but they know that if you did have a tough 2 to 3 months where you were in between, let's say you were buying a long-term rental property where one tenant moved out and it took you 2 months to get a new tenant in, you have the assets that you can pull from out of that Charles Schwab account or market account. And then you're not liquidating the whole account, but you're able to cover it, right? And that's kind of what they're looking for. They're not holding it hostage or pledging it against the asset. It's really just a method of qualification. Whereas now I'm not having to bring tax returns to the table.
Okay. Okay. And another final scenario, if an investor, like another avatar, let's say, an investor who already owns a couple of rentals and they're bumping up against the conventional cap in terms of financed properties or anything else, what kind of loan products do you offer or strategies that they could use to finance additional acquisitions?
So there's a couple of different ways we can look at it. We can go to some of our resources. So we have some banks and lenders that some of them cap out at 10, but some of them have no cap or they cap at 20, right? Properties. We could also do something where we could bundle up three or four of them together and put them in a master loan. So it'd be like a cash out refi or just a rate and term refinance. So let's say you own 10 properties and you're having a hard time buying that 11th and 12th one because everybody's saying, no, you already owe 10, you're at our cap, we can't take that. What we can do is take 6, 7, 8, and 9 and 10, those four, and bundle it with your two that you're trying to get, and then that is a master kind of loan. And so then you have multiple properties in that same umbrella. So that's one strategy that we could do. Obviously, the easiest strategy is for us to work with some of our people who have a higher cap or no cap, in terms of, as long as you're covering the rent, as long as the investment return is covering what the payments are and ratioing out, then they can feel good about underwriting and loaning you the money. Now we also have like scenarios where it doesn't make sense, right? It doesn't ratio out to one or above one, as they say, in terms of the rents aren't covering everything that needs to be covered. We can still lend you money on that property that you have some rents in. There may be another piece that we need to bring in, like just as a buffer, or we can do it as what they call a no ratio loan. It's just a small interest rate hit.
Okay. So at
So,
least go ahead.
I was going to say, so there's a lot of options that are open to us. If the rent covers, perfect. If the rent doesn't cover, we have options for that too.
So all these alternative strategies to finance properties and investments are great. And I guess the one thing would be my question is, I guess I've been asking a lot of questions.
No,
How can a borrower tell when something is a legitimate creative financing tool versus something that they should be running away from, whether it's a loan shark or someone else? I think especially since the private, I don't know if you would group this in the private credit industry, but this private lending has really grown into a beast of its own in terms of a financial product out there. So how can someone, what should
I
someone
would
keep
say
an eye out
kind of
for?
look at the red flags and then talk to more than one person, right? Or reach out to us and tell us your scenario and what the rate and term is, and we can kind of help you walk through that. If it doesn't make sense, it doesn't make sense, right? Like where you need to look at it is if they're charging from a hard money standpoint excessive rates and fees, right? Or you get into a layer cake. So the broker wants excessive fees, the bank wants excessive fees, the family office, right? So watch your points up front, right? If you get into a scenario where they're charging you 3, 4, 5 points, that may be what it takes to get the hard money loan to get the property under your name. But there may be other options that don't charge that many points up front. And then the other thing is take a look at the rate. There's a lot of rates and programs out there that are really within reason close to if you're buying a primary home jumbo right now. It used to be 2, 3 years ago, the spread between a kind of a business purpose investment property loan and if you're buying a primary home that may be a jumbo or super jumbo, there was a bigger gap there. Now that gap's kind of closed down. And we're quoting on $2 and $3 million properties rates in the low to mid sixes. And that's kind of right where if you were going to buy a personal home, your primary home is going to be in that kind of same jumbo, super jumbo range. And so that gap is closed. So if you see anything that's way past that, then I would look at two things. One is what are they asking you for down payment? So what is your skin in the game? The more skin you put in, the better the rate should be, the lower the points should be, right? And the second thing is what is it that they're giving you? Are they giving you like a 24-month balloon hard money loan? It's going to cost you 4 points and it's at a 12% rate. That that could be a viable option if that's all that you have that's available to you right now based on whatever criteria that they're using that for. but there are other options out there that are much better than that, is what I'm saying. And so if you're getting into double digit, and it's not a hard money loan, but if you're in the double digits and you're in high points, then I would start making some phone calls to other people.
Gotcha. Okay.
Yeah, because
Great.
I agree.
Well,
There's not a lot of middle, right? So there's people out there on one end of the spectrum charging a lot, like hard money, and then there's the banks, but the banks are going to say no a lot of times. They have good
yeah.
rates, but no access. Thank you, but no.
Yeah. Okay. We have about 10 minutes left here. So with that, we have a couple questions that we like to ask all of our guests.
Perfect.
So the first one, what's a failure earlier in your career that ended up teaching you the most?
Failure earlier in my career that ended up teaching me the most. I would say that I I was going after this one job, and I was way early in my career, and it seemed like the perfect job. It was a global company. I was going to be in this city for 18 months, and then this city, and then over in the UK, and then possibly Asia. And so it sounded really great. And I went all the way to the end of the interviewing process. I didn't get the job. And so I'm like, okay, must be a reason for that, because I thought I had it in the bag. And then what it did was is it taught me there were a lot more options available. I ended up getting a better job, but my heart was like set on that one, and it didn't happen. And kind of I felt crushed when there was a couple of other job offers that were on the table that I passed on because I thought this one was in the bag. You know what I'm saying? And so it taught me, even to this day. Like, we have a closing that's set on Friday, we have another one that's on Tuesday. I always say, until it's closed, it's not closed, right? Until the deal is done, it's not done. And that's the way I had a chance. I let some really good job offers at that time go away because I thought, oh, I got this one. It's in the bag. It's perfect, right? And then the last day, it didn't happen, and I'm like, now I got nothing. So now that kind of just taught me patience. Just ride out the course. Make sure that you keep viable options, backup plans, that kind of stuff. But I was younger and I wasn't paying attention. But ever since then, I've always paid attention to all options.
Yeah, one of my first few capital raises, an investor had I was excited to just get investor capital in, and he sent the money in, and then rates went up, and we hadn't closed on the property yet. And so he asked for his money back. And so I celebrated that one a little bit too quickly too.
Yeah. Yeah. See, now you know, right? Till it's
Yeah,
done, it's not done. Yeah.
agreed. Okay. And then knowing what you know now, what would you tell yourself 10, 20 years ago?
Get in the right rooms early, right? If you feel like that if you feel like that you're at kind of the top of the room, then you're in the wrong room. Go to the room where you're in the bottom and you're learning from more people, right? So either from a mentorship, from just there's different playbooks. Like, we didn't know, even the first investment property that we bought, we weren't operating under the playbook that we know that we have now, right? And so just constantly trying to get into bigger, smaller, more opportunistic rooms. And when I say that, I'm just saying that in general, just like the circle of people that you work with, the people that you talk to. Always keep pushing yourself. If if you feel like you're the most knowledgeable and the smartest and the most opportunistic in your circle or sphere, then go find another sphere where you're at the bottom and you're starting to learn from people, because there's always going to be someone that can teach you something. And so that's what I would have told myself back then, is like, constantly, okay, hey, shut the door on that room, get into the next room. Now you're at the bottom, right? You're at the top in that room. Now you're at the bottom, work your way up, figure out what you can learn, what are the new playbooks, what are the new networking capabilities, and then just constantly do that. And I think that I wish I would have done that earlier.
That's great advice. Yeah.
Yeah.
Okay. And for those interested, what's the best way to reach you and learn more information about you and your firm?
Yeah, a couple of great ways. You can go to our website, it's marshlending.com. You can reach out to us. Hello@marshlending.com is a good email to get in touch with someone, and we'll be right back to answer your questions. And then if you go to YouTube, we're on all the social channels, but specifically if you go to YouTube, we did a whole series on and all the questions related around investment properties. And so we had a panel and we worked through everything. So if you want to learn more about owning an investment property or what does it take to own an investment property, there's a whole series on our YouTube channel, which is at Marsh Lending, and you can get some good information there.
Great. Thank you for joining us today
Yeah.
to teach us more about creative lending, Aaron. To learn more about these lending strategies and products that traditional banks don't offer, you guys just heard Aaron's contact information and the best way to reach out. So definitely do that. And we'll include that information in the description as well for this podcast. And I would say some of the big things that we learned is why traditional banks don't offer some of these products or who they don't offer these products to, what the alternatives are, that these alternatives do exist as well, and that just because one bank tells you no or three banks tell you no, doesn't mean that it's the end of the world and that Aaron and Aaron's firm can help you out there. So thank you for taking time out of your busy day, Aaron. We appreciate you joining us. And for those of you listening at home, this is Investing for Generational Wealth. Wherever you're listening, give us a like, subscribe to us so that you can receive more content just like this. And until next time, keep investing for generational wealth.
I appreciate it. Thank you so much for having me.
Thanks, Aaron.
All right.